Okay, so you want to own a hotel, a building with 100 rooms or more, each one generating a check every night someone sleeps in it. The guests check in, the housekeeping staff turns the rooms, and somewhere between the breakfast service and the checkout line, a steady flow of income arrives without you personally doing anything visible. Multiply that by 365 nights a year, and the math starts to look like something worth pursuing. Sounds simple. It is not simple. And the story of how hotels actually make money and how they actually collapse is one of the more complicated stories in all of real estate, hiding behind the business that most people interact with dozens of times in their lives without ever thinking about what's happening on the other side of the front desk. Before you check in a single guest, you need to survive building or buying the thing. A mid-scale hotel of around 100 to 150 rooms in a secondary American city is not a modest investment. Building from scratch on empty land, accounting for the foundation, the plumbing and electrical systems, the elevators, the fire suppression systems, the parking structure, the pool and fitness center if your brand requires them, the furniture, fixtures, and all the equipment that makes the hotel function can run $150,000 to $350,000 per room, depending on location and quality level. On a 120-room property, that's $18 million to $42 million before you've hired a single front desk employee or stocked a single minibar. A full-service hotel in a major urban market, the kind with a restaurant, conference rooms, a spa, and a significant lobby presence, runs substantially higher. Upper upscale and luxury properties in gateway cities have been built for $500,000 to over $1 million per room. A 300-room luxury hotel in a city like New York or San Francisco can represent a total development cost that exceeds $300 million. Buying an existing hotel is usually cheaper up front, but that's where things get interesting because not all hotels are the same hotel. There is a large gap in this industry between what professionals call upper upscale and luxury properties and everything below them. A well-located full-service hotel with a strong brand affiliation, consistent occupancy above 70%, and a position in a market where new supply is constrained can trade for enormous sums. Then there are the hotels 2 or 3 tiers below. Older, limited-service properties in secondary markets with deferred maintenance, aging brand affiliations, and rooms that haven't been meaningfully renovated in a decade. Some of these sell for a fraction of replacement cost because the income they produce barely justifies keeping the lights on, let alone covering debt service on a new acquisition loan. So here is the first thing nobody tells you when they picture owning a hotel. You're not buying a building, you're buying a business that operates inside a building. Every single day, 7 days a week, 365 days a year. The building is the easy part. The business embedded in it is what determines whether the investment works. Most people who own hotels today, by the way, don't own them the way you might picture. The largest hotel groups in the world, Marriott, Hilton, Hyatt, IHG, are primarily not hotel owners in the traditional sense. They are brand companies and management companies. They license their names and operating systems to property owners in exchange for fees, and they manage those properties for a separate management fee on top of that. An investor or ownership group holds the actual real estate, while a Marriott management team runs the day-to-day operation and a Marriott brand name sits on the sign out front. The owner is essentially a landlord to a business they don't directly control. This separation between ownership and operation is fundamental to understanding how the economics actually work, and it is the source of some of the most persistent tensions in the industry. Say you've committed to a property and the numbers look reasonable on paper. Before a single guest swipes a credit card, there are layers of costs that catch almost every new hotel owner off guard. First, there are the brand fees you inherit or agree to when you affiliate with a major chain. A franchise agreement with one of the major hospitality brands typically includes an initial fee, a royalty on gross room revenue that can run 4 to 7%, a marketing contribution of another 2 to 4%, a reservation system fee, and various program fees for loyalty points, digital platforms, and quality assurance programs. Add those up, and a franchise hotel can be paying 10 to 15% of gross room revenue to the brand before paying a single operating expense. In a good year, this is the price of the customer flow the brand delivers. In a bad year, it is money leaving the building regardless of how full the hotel actually is. Second, there's the physical reality of operating a building at this scale, every day, indefinitely. Hotels experience wear and tear at a rate that most commercial real estate doesn't. Guests use the furniture furniture, the fixtures, the carpets, and the bathrooms in ways that offices and retail spaces simply don't. Industry standards suggest that hotel owners should budget roughly 4 to 5% of total revenue each year for what's called a property improvement reserve, money set aside specifically to fund the renovations and replacements that maintaining brand standards requires. Brand affiliation agreements often mandate specific renovation schedules, which means that even if you're satisfied with the current condition of the property, the brand may require you to spend significant capital upgrading the rooms, the lobby, or the technology infrastructure on a timeline the brand sets, not you. Third, there's the structural cost of staffing a business that never closes. A hotel with 150 rooms might employ 60 to 100 people across housekeeping, front desk, food and beverage, maintenance, and management. Unlike most retail businesses, which can scale staffing up and down with reasonable flexibility, a hotel must maintain minimum staffing levels around the clock, regardless of occupancy. The front desk cannot close at 9 in the evening because occupancy dropped. Housekeeping cannot take Tuesdays off because Tuesday is slow. Security has to be present whether you have 12 occupied rooms or 148. The labor cost structure is, in large part, fixed, and it runs against revenue that is anything but fixed. Here's where it gets genuinely interesting, because the way hotel generates income is more layered than most people realize.
The first and most obvious layer is room revenue. Every occupied room produces a rate, and the financial health of a hotel is tracked almost universally through a metric called RevPAR, which stands for Revenue Per Available Room. RevPAR is calculated by multiplying the hotel's average daily rate by its occupancy percentage. A hotel charging an average of $150 per night at 72% occupancy is producing a RevPAR of $108. That number is the single most watched metric in hotel finance because it combines both price and volume into one figure. A hotel can look healthy on occupancy and be destroying value if it achieved that occupancy by cutting rates below what costs require. A hotel can look underperforming on occupancy and be highly profitable if it's running at a high average rate against a lean cost structure. Occupancy and profitability are not the same thing, and optimizing for one while ignoring the other is one of the most common and costly mistakes in hotel ownership. The second layer is food and beverage. A full-service hotel with a restaurant, bar, room service, and banquet facilities can generate between 20 and 35% of total revenue from food and beverage alone. But food and beverage in hotels is one of the most operationally complex departments in hospitality, with food costs, labor costs, and waste levels that can easily eliminate the margin if not managed tightly. Many hotel owners discovered over the past 2 decades that outsourcing the food and beverage operation entirely to an independent restaurateur or specialized management group produced better outcomes than trying to operate a restaurant inside a hotel business that was already demanding enough.
The third layer is meetings and events. A hotel with well-designed meeting rooms, ballroom space, and event infrastructure can generate significant revenue from corporate events, conferences, weddings, and social gatherings. This segment is particularly valuable because it often includes not just the room rental, but catering, audio-visual services, and guest room blocks for attendees. A single large corporate conference can occupy hundreds of room nights over a multi-day event, while simultaneously generating tens of thousands of dollars in banquet and meeting room revenue on top of that. The challenge is that events business is lumpy. It arrives in large, concentrated blocks and requires significant advanced sales effort. The months with 3 large events booked in advance look completely different from the months with none. The fourth layer is what the industry calls ancillary revenue. Parking, which in urban hotels can be a meaningful business in itself, spa and fitness services, resort fees, which are separately charged amounts for amenities including pool access, fitness centers, and internet, and which have become a significant and increasingly controversial revenue line across the industry, business center services, golf in resort properties. None of these categories individually dominates most hotels' income, but together they can add up to 10 to 20% of total revenue at a well-amenitized property. There's a counterintuitive detail hiding inside all of this worth pointing out clearly. The most expensive room in the building, on the right night, can be among the most valuable decisions a hotel makes all year. Revenue management, which is now an entire discipline within hotel operations, is fundamentally about pricing each room on each night to maximize total revenue across the whole property. A room that sells for $400 on a Tuesday in October when a major convention fills the city is generating more value than the same room sold at $120 to keep occupancy numbers looking healthy on a slow Wednesday in January. The discipline is not about filling rooms, it is about what you fill them for. Now here's the other side of the ledger, because the expense structure of a hotel is one of the most demanding in all of commercial real estate. Labor is the largest and most fixed operating cost, typically representing 35 to 50% of total revenue at a full-service property. Utilities, on a building that is climate-controlled, lit, and operating every hour of every day, run substantially higher than comparable commercial buildings with normal operating hours. Property taxes on a large hotel in a major city can run into the millions annually. Insurance has climbed significantly across the hospitality sector, and then there's the debt service on whatever was borrowed to buy or build the asset, which arrives every month regardless of whether the economy is growing, whether there's a labor shortage, or whether a global event has just reduced travel demand to nearly zero. There's a detail buried inside the distribution cost structure that catches new hotel owners off guard faster than almost anything else. Online travel agencies, the platforms like Booking.com and Expedia, through which a significant share of hotel rooms are now sold, typically charge commissions between 15 and 25% on every reservation they produce. For a hotel doing $3 million in annual room revenue with 40% of its bookings coming through these platforms, that commission line represents $180,000 to $300,000 leaving the business each year before a single operating expenses paid. The platforms deliver real customers, but the cost of that customer acquisition at 15 to 25% of the transaction is dramatically higher than what the hotel pays when a guest books directly through its own website or loyalty program. The entire industry's effort to drive direct bookings through points programs and best rate guarantees is fundamentally a fight to reduce how much of every revenue dollar disappears through commissions before the hotel gets to count it as income. Conrad Hilton bought his first hotel in Cisco, Texas in 1919 for $40,000, at a time when hotel ownership was primarily about selling beds. A room was a room. You slept in it, you paid for it, and that was a transaction. What Hilton understood, and what he applied systematically across every property he eventually acquired, was that a hotel is not a building that sells sleep. It is a building that captures the spending of a concentrated population of people who are away from home and have already decided to pay for convenience. He asked a question nobody in the industry had thought to ask systematically. What else do these people need, and why is someone else providing it when they're already standing inside my building? He converted unused lobby space into commercial tenants and service businesses. He developed a concept of maximizing revenue from every square foot a guest might pass through, not just the rooms they slept in. The modern concept of total hotel revenue, as opposed to just room revenue, flows directly from the logic he refined across a career spanning 5 decades and hundreds of properties. Every hotel today that earns meaningful income from its restaurant, its parking garage, its spa, and its meeting rooms is operating on a version of the question Hilton was the first to ask at scale. Now here's the structural risk that runs through the entire industry, and it's best understood through something that actually happened at massive scale. Before we get to how hotels fail, it's worth understanding something that one man figured out almost a century ago, because it changed the entire commercial logic of the business. For most of the late 20th century, the extended stay hotel segment looked like one of the most durable subsectors in all of hospitality. Guests checking in for a week or a month were more predictable than leisure travelers. Corporate relocation business, project-based workers, and people in transitional living situations all generated longer average stays and lower housekeeping costs per occupied room night than traditional hotels. The economics look stable because the customer base looks stable. Extended Stay America built an entire business on exactly that assumption. Founded in 1995, the company expanded aggressively through the late 1990s and 2000s. Acquiring and building extended stay properties across the United States. By 2007, the company operated 682 hotels with nearly 76,000 rooms, making it one of the largest hotel operators in the country by room count. The business had real occupancy, real revenue, real corporate accounts, and an enormous amount of debt. When the financial crisis arrived in 2008, the corporate relocation business and project-based travel that had been filling extended stays rooms dropped sharply and did not recover quickly. The revenue declined. The debt remained exactly as large as it had been before. In June of 2009, Extended Stay America filed for Chapter 11 bankruptcy protection, with approximately $7.4 billion in debt, making it one of the largest real estate bankruptcies in United States history at that point in time. A business that operated 682 hotels across the country, that had real guests sleeping in real rooms every single night, collapsed not because the hotels stopped working, but because the capital structure built on top of them stopped being serviceable the moment revenue declined. declined below the level required to support it. The properties eventually sold out of bankruptcy for roughly $3.9 billion, less than what the debt alone had been worth. The hotels didn't change, the economics underneath them did. The extended stay collapse and the broader struggles of mid-market hotel ownership didn't happen in isolation. They happened alongside two forces that permanently changed how hotel rooms get sold and who captures the value of filling them.
The first force was Airbnb, which launched in 2008 and grew from a startup renting air mattresses in a San Francisco apartment into a platform with millions of listings globally. What Airbnb did to the hotel industry wasn't simply adding supply. It changed the fundamental assumption that a traveler choosing accommodation was choosing between hotels. Suddenly, a guest who might have booked a $180 hotel room could book an entire apartment in the same neighborhood for a similar or lower price, with a kitchen, a living room, and the feeling of actually living somewhere rather than passing through it. The hotels most affected were the ones stuck in the middle. Not distinctive enough to sell an experience Airbnb couldn't replicate, not cheap enough to win purely on price against a private room in someone's home. The second force was a concentration of brand power at the very top. Marriott's acquisition of Starwood in 2016 created a company with over 30 brands and more than 1 million rooms worldwide. The loyalty program that resulted became one of the most valuable assets in the combined company, not because of the rooms it sold, but because of the data it held and the switching costs it created for frequent travelers who had accumulated years of points and had no interest in starting over. An independent hotel competing against a property flying a Marriott or Hilton flag in the same market isn't just competing on room quality or price. It is competing against the loyalty inertia of millions of travelers who book within a system they've already committed to, for points they've already accumulated and are not willing to abandon. So, does owning a hotel actually work as a business? The honest answer depends entirely on which hotel. And the gap between the good outcome and the bad outcome in this industry is wider than in almost any other class of real estate. In the optimistic scenario, you own a well-located, well-branded property in a market with genuine and growing demand and limited new supply on the horizon. Your REVPR is strong. Your group business fills the shoulder periods when leisure travel is slow. Your food and beverage generates a real contribution rather than a drag. Your debt structure was conservative enough to absorb a weak year without threatening the asset. In that case, hotel ownership produces returns that justify the operational complexity, and the underlying real estate appreciates as the market builds around it. In the realistic bad year scenario, an economic slowdown reduces corporate travel budgets, and your group bookings evaporate 6 months before they would have otherwise appeared on the books. A new branded property opens nearby and compresses rates across your segment. Your brand mandates a $4 million renovation on a timeline that overlaps with the weakest occupancy period in 3 years. Your OTA commission costs rise as direct booking declines, and your revenue manager cycles out for a competitor. And the debt payment arrives on the same week as the property tax bill. In the same month, the main HVAC system on the third floor needs emergency replacement. None of these is a catastrophe in isolation. Together, in the same year, they can be the beginning of a conversation with your lender that you did not plan to have. Extended Stay America lived through the optimistic version for over a decade, expanding, growing, operating at scale. Then, the realistic version arrived, not in a single event, but across a sequence of quarters, and the business never found its way back to the other side. The hotels were still standing. The economics underneath them had simply stopped working. A hotel looks from the outside like a building where people sleep and eat and hold meetings. From the inside, it is an economy running in miniature, every single day against a fixed cost structure that does not negotiate, does not take weekends off, and does not care what the occupancy report said last night. The room isn't the product. The reason someone chooses to be somewhere they've never slept before is.